Target just reported their Q3 earnings, and the market is not liking the results. Target stock is now down 21.42% on the day, and it's the worst one-day decline in Target stock since May 2022. This now makes the company down 4.25% over the past 5 years. So what happened? Today I'm going to analyze Target's latest earnings report and explain why the stock is down. I'll also share whether I think this is now a buying opportunity for Target, given that it's a long-term dividend growth stock trading at a 3.69% dividend yield. I'll do a discount cash flow analysis on Target stock and even take a look at analyst price targets. I will also compare Target's latest earnings to other retailers like Walmart, which also reported this week. So we got a good one ahead. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using the best stock research tool, dividenddata.com. I'll specifically be highlighting a great new use case of my AI investment analyst. You can ask it to summarize the latest quarter and earnings call for any company, like I will today for Target and Walmart. This saves you hours of listening to earnings calls and reading reports, and you can get the most important metrics summarized for you right away. And of course, that's just one of the many features available on dividenddata.com. If you sign up today, you can get 50% off for life, which is the best deal we will ever offer. Just click the link in the description and pin comment to get 50% off, or create an account via the web app, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI. Now let's get to the Target stock news. And the first thing we should bring up is that they missed analyst projections on their earnings. Revenue came in 0.9% below expectations at $25.67 billion. But here's the real important part. Earnings per share for the quarter came in at $1.85, which was 19.57% below expectations. And what do you know? The stock is now down 22%. But let's dive into what actually happened in the quarter that was causing that decline in earnings, and also explain why their guidance could be a part of the problem for that big stock decline. On the positive side, Target experienced healthy traffic growth of 2.4% year over year in the quarter, and that equated to over 10 million additional transactions. So that's actually a very positive thing for Target, and it's hard to imagine that they couldn't see increased earnings and revenue from that. But if we read further, it says, however, this was counterbalanced by a decline in average ticket size as consumers shopped cautiously, particularly in discretionary categories like apparel and home. And if we look at a breakdown of Target's revenue by segment, you can see that apparel is $16.5 billion and home and decor is $17.3 billion. So that's about 1/3 of their total revenue over the trailing 12 months. So they saw increased traffic, but they had to cut prices in a large portion of their business. Comparable sales grew by 0.3%, which was on the lower end of their expected range. But again, on the positive side, they saw digital sales increase nearly 11% year over year. Target cited that profitability was down in the third quarter, impacted by softer sales in high margin discretionary categories, along with higher supply chain, healthcare, and liability costs. They had $1.85 of earnings per share for the quarter, which is down 11.9% compared to the prior year. And here's a very important part, which is the outlook for Q4. Target is planning cautiously for Q4 due to ongoing consumer uncertainty and volatility. They expect Q4 comparable sales to be around flat, with a full year EPS projected to be in the range of $8.30 to $8.90. And if we go to the stock analysis tool on dividenddata.com, you can see that analysts were projecting previously full year earnings per share for Target of $9.56. So that is a big reduction. And after this 21% decline in stock price, that would put the PE ratio, if we take the high end of $8.90 earnings per share, that would make the PE ratio be 13.59. So that's actually pretty low and might signal that Target is a potential value play long term. However, they definitely are in short-term troubles and will likely not reach these 2021 highs in earnings per share for many many, many years to come. It looked like they were starting to grow again, but this recent downtrend has signaled weakness. And that's why the stock price is falling off again after starting to recover in early 2024. But in terms of the dividend, this does create a pretty good starting dividend yield for Target stock. A 3.7% dividend yield is in the historical high range. This higher dividend yield is the highest point since the fall 2023 lows. And excluding that, it's the highest dividend yield since 2018 and 2017. And Target has shown to be a long-term dividend growth stock with a 10-year dividend CAGR of 7.97%. It is sustainable too. It has a 52% payout ratio based on free cash flow and a 48% payout ratio based on earnings per share. However, dividend growth is slowing significantly, and it will likely continue to be low until they accelerate earnings growth. The two prior dividend increases came in at 1.82% and 1.85%. I would not expect high dividend growth from Target stock anytime in the coming years. However, this is a company that consistently returns capital to shareholders via dividends and share repurchases. They announced that they repurchased $354 million of its shares in Q3 2024. I would expect this continues. Now I'm going to share some insight from an analyst who went on CNBC earlier today. He discussed Target's latest quarter and theorized it may be a value play right now, but I thought he did a really good job comparing it to Walmart's latest quarter, so I will touch on that as well.
It's instructive to compare Walmart and Target in this situation. What we saw from Walmart yesterday was that it's executing on all cylinders, and one of the features of its model is now these alternative revenue streams that create some insulation for other factors within its business in the event that there are challenges. In fact, 1/3 of Walmart's overall profitability growth this quarter came from advertising revenue and membership fees. Those are two areas that Target under indexes in. And by virtue of not having those profit pools, Target's model is just more sensitive to hits and misses, especially when you consider that Target generates 1/3 of its sales from style categories, home and apparel. And those are going to be more sensitive to inventory obsolescence, different trends. And as a result, they may have to discount excess inventory to clear out. Then that's going to act as a hit to the margin. And that's what I think we saw with both of these retailers this quarter.
That was actually a great analysis, in my opinion. Not only did Walmart's core retail business perform far better than Target's by comparison, but Walmart has this growing stream of membership and other income, which includes things like advertising. The company saw significant growth in e-commerce, up 27% year over year. Advertising was up 28% year over year, and membership income was up 22% year over year. And yes, that's small revenue currently, but the most important part is that it's a high margin business. Advertising and membership is extremely high margin for Walmart compared to their very low margin retail business. And as he mentioned in the call, 1/3 of Walmart's increase in earnings came from those high margin businesses. And on my earnings predictions video earlier this week, I talked about Walmart's membership and advertising business. Since October 2020, trailing 12 months revenue has grown from $3.8 billion all the way now to $6.2 billion over the trailing 12 months. If you're bullish on Walmart stock, this is the reason to be. This is growing, high margin, and reliable revenue. And if we just look at Amazon's e-commerce business, advertising is their most profitable segment by far. Target, by comparison, does not have any of that in their business. They are a pure play retail, and they also are not as resilient compared to something like Walmart because Walmart's able to offer far lower prices and they're not as heavily in discretionary categories. And it's for that reason that Target trades at a much lower profit multiple. But that lower valuation could be an opportunity for investors getting into Target stock, especially if they can re-accelerate growth to prior levels.
Target's a bit more of a volatile model, but it's reflected in its very inexpensive valuation. Just to put some perspective around that, I think there's still very good case that it can earn $10 of earnings next year. And with the stock trading at $125, $130 in the pre-market, it's 12.5 to 13 times earnings for what is still a retailer that generated more than 2% growth in traffic, more than 11% growth in digital sales in the quarter. So that's how we look at it right now.
I'm going to do a brief discount cash flow analysis for Target. This will estimate the intrinsic value of the stock. Then I'll provide some analyst price targets and whether or not they think Target is undervalued or overvalued. Again, all of this is available on dividenddata.com in our new AI analyst tool. You can sign up now and get 50% off for life. So I asked for a Target discounted cash flow valuation, and it brought up this nice calculator that autofills with Target's financials. However, I am going to edit around with the data so that I think it better reflects how Target will do over the coming years. I'm going to leave their 2025, 2026, and 2027 revenue growth rates, but I am going to put in higher than 0 for 2028 and 2029. I'll put 4% for both. That is slightly lower than analysts were projecting for revenue growth in those years. I also am lowering the CapEx in the future years, given that they are on a trend of lowering it in 2025. And I'm going to leave the EBIT margins at what they had because I don't think they'll be getting back up to those 2022 levels anytime soon. So here you can see what that estimates in free cash flow over those years, going from $2.8 billion, ending at $3.3 billion in 2029. And that might end up being pretty low because historically Target did free cash flow of $4.7 billion in 2022 and had anywhere from $3 to $7 billion in free cash flow in the past decade. But in 2023, they had negative $2 billion of free cash flow. And my calculator for Target stock defaulted to a free cash flow multiple of 33.53. And I would say that's pretty ridiculously high, but I think that's what Target was trading at. That gives an implied share price of $140.11, which implies 15% upside from the stock price after the recent fall. However, if we lower the free cash flow multiple to something I view as more reasonable, like 20, considering their low growth rates, that would put the implied share price at $80.42. But again, that was considering pretty low increases in free cash flow. So I'm going to be a little more generous and assume that they can grow their EBIT margin in 2028 and 2029 back up to that 8% range. And then you can see that they'd be generating $4.8 billion and $5 billion of free cash flow in those years, which I think actually could be possible. And even with a 20 free cash flow multiple, those more bullish estimates would give it an implied share price of $131. So that would signal that Target stock is trading below fair value. Among Wall Street analysts, Target stock has a mean price target of $173.82. And this may come down after this poor earnings report, but that would imply 40% upside from here. And prior to the report, the lowest price target for Target stock was $119. And that is extremely close to the current price. So based on that, if you bought Target stock today, there could be significant upside in the coming years. But all of that is just my opinion looking at the data. You should do your own research and consider your own personal finance goals before making any investing decisions. I do not personally own Target stock in my portfolio, but it definitely gets a little more interesting after this 20% sell-off. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. If you want to use the stock research tool I showed today, then sign up at dividenddata.com. If you join now, you can lock in 50% off for life. Just click the link in the description and pin comment of the video, or create an account on the web app, select your plan, and enter the promo code AI at checkout. Thanks for watching, and I'll see you in the next video.